Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 77, we're going to take a dive into some of the basics of a common estate planning transaction or planning strategy known as the sale to an intentionally defective grantor trust. Now on its face that sounds weird. Why would you have a trust that's intentionally defective? But we're going to figure out why and how that trust is defective and how that defect actually benefits you when it comes to tax planning. Now, as always, this presentation is not intended to substitute for legal or tax advice. So, what is the purpose of this transaction? Well, when you sell assets to a grantor trust, it has the same real goal or outcome as a gift in that you're trying to freeze the value of an asset for estate tax purposes. The difference is just how the outcome is counted in the estate tax calculation. In the case of a gift, the value of the gift is included in the adjusted taxable gifts bucket when calculating your estate tax liability. So in essence, you remove the post-gift growth of the value from your tax base for estate tax purposes with a gift. Well, the same thing holds true with a sale transaction, but the outcome is a little different. Instead of looking at the adjusted taxable gifts, instead what you do is you exchange the value of the sold asset for a promissory note that's included in your gross estate, plus payments back on that note over time as well. So, instead of having an adjusted taxable gift, you have an asset in the form of promissory notes plus previously received payments, which are included in the gross estate. But once again, minus interest, the post-sale growth in the value of that sold asset is included in or excluded from the gross estate. So this is usually done in a situation where there's an intent to avoid gift tax liability or the use of a gift tax exemption. Now, if you want to avoid gift tax filing, as we're going to see, this may not be a good strategy if you want to make sure it's done right. Now, an added benefit is that since this is a sale transaction, you avoid the risk of having a retained interest under Code Sections 2036 or 2038. So this allows you to essentially convert an illiquid asset into a stream of income without having to use a form of trust that's been blessed by the IRS, like a GRAT, or it allows you to essentially retain that income stream and argue that there was a sale or exchange which could keep Code Section 2036 from applying. But keep in mind, too, that your income stream under the promissory note would be included in your gross estate. So why is the trust called defective? Well, the reason is that because for income tax purposes, it's a grantor trust, which means that the IRS ignores the existence of the trust only for income tax purposes, but the IRS would respect the existence of the trust for gift and estate tax purposes. So this allows you to sell an asset to the trust, and it's important that it be a grantor trust for that sale element as well, because essentially, if the trust is ignored, it's as if the grantor is selling assets to the grantor, which is a tax nothing. So that means that any gain on the grantor's sale of the asset to the grantor trust wouldn't be subject to income tax, nor would payments of interest from the trust back to the grantor on that installment note that I mentioned. However, keep in mind again that grantor trust status is only relevant for income tax purposes, and an important point is that you have to cause the grantor to retain certain powers or rights in order to trigger grantor trust status. And there's a crossover, a Venn diagram, where those retained rights could also potentially be treated as retained interests under Code Sections 2036, 2037, 2038, or 2041. And if those code sections were to apply, it would null the goal of this transaction in that it would cause that post-sale growth of the sold asset to be pulled back into the gross estate. So you don't want a retained power. Thus, to make it a grantor trust, what often happens is that the grantor is given an administrative power, such as the right to substitute trust assets with assets of equivalent value. And that administrative power wouldn't necessarily rise to the level of being retained possession or enjoyment or control, or the right to revoke or amend, which could cause any of those bad code sections to apply. Now, some of the elements, the must-haves, include obviously an irrevocable trust that's taxed as a grantor trust, as I mentioned, at least at the time of sale. Post-sale, you could potentially flip it back over to a non-grantor trust, but you'd want to ideally wait until the note is paid off, which also brings into mind a promissory note plus an upfront gift. You have to fund this somehow, and we'll look at the funding in great detail, but usually you can't completely avoid any sort of gifting element here. You have to have an upfront gift of some cash which can be used as a down payment back to the grantor. You have to make this look like a legitimate sale, including a down payment and installments over time, which raises the question, why not just gift the entire purchase price? Well, if you want to avoid using gift tax exemption, there's no point in gifting the entire purchase price. It's that sale element and that promissory note payable back to the grantor that keeps you from having a gift. So instead of having a gift of 100% of the sale, you might have, for example, a gift of 10% and then a sale of 90%, as we'll see. Then you want a promissory note that pays back the balance of the purchase price over time with interest. Now, some important to have elements are a purchase agreement, a security agreement for the repayment of the promissory note, so that there is an enforceable obligation if the trust doesn't pay back the grantor. You'd also want trust assets that generate enough income to pay the note, but not necessarily an income stream that directly correlates to the value of the installments on the note, because that could be treated as a retained income interest by the IRS. Then finally, as we'll see towards the end, it's helpful to have a gift tax return. Even if you're trying to avoid that filing obligation, you want to make sure you can lock in the valuation of the sold asset. Now, I mentioned the down payment, and there's a lot of practitioners out there who have pulled out of thin air and perpetuated this myth that you have to have a safe harbor down payment of 10%. But that hasn't necessarily been condoned or condemned in any sort of IRS ruling. That's just a random number that people have pieced together impliedly from several rulings and cases and things of that nature. It doesn't have to be 10%. It could be less or more depending on the circumstances. So the down payment is gifted to the trust and then repaid to the grantor shortly thereafter with a promissory note. And then the asset should generate ideally enough cash to pay the installments over time so that the note is enforceable. That makes business entities work well, depending on the term of the note and stated interest. But with business entities, you also need to take into account the effect of the taxation of the income of the business entity itself. Since this is a grantor trust, with, for example, a pass-through entity, there could be phantom income that comes to the grantor, and if it's a C corporation, then the grantor is going to have to pay a dividend tax on any C corporation earnings that come out to the trust to pay the installments on that note. Then finally, you want a valid written promissory note. There's no required term, but there's some factors to consider that really kind of depend on the facts and circumstances of the planning strategy and the grantor. For one, this isn't necessarily a hard and fast rule, but I find it helpful to have a note that has a term shorter than the grantor's life expectancy. That way, if the grantor dies with the note being outstanding, it's based on an early death and doesn't show an intent to never have the note paid back. Also, interest should equal or exceed the applicable federal rate that's published by the IRS monthly. That's currently very low, but could go up over time, but it's usually below market interest anyway. The terms should not be so short on the note so as to create a liquidity problem. So if you have enough income to pay it back over 10 years, you don't want a 2-year or a 5-year note. Then finally, you want this note to be enforceable. You want it to have terms that make it seem like this was an arm's length lending transaction like you'd get from a normal commercial lender. So you'd want adequate security in there as well, so that if the grantor isn't paid back, you could go back and maybe seize the asset from the trust or claim some other collateral as enforcement for the unpaid payments under that note. Now, the purchase price also should not be estimated. This isn't a loosey-goosey type of thing. You really need a qualified appraisal, and you need to file a gift tax return to start the 3-year limitations period on that gift tax valuation running. Now, the cost of not doing so is that if at death the IRS digs into this and determines that the purchase price up front was actually less than the fair market value of the asset on the date of the sale, the IRS could come back and force at least partial estate tax inclusion under Code Sections 2036 and or 2038. Now, you could always defend this as being a bona fide sale for full and adequate consideration, at least in part under Code Section 2043, but at best, what that would do is still force some portion of the post-sale growth back into the gross estate. So it's important to have a qualified appraisal before you put pen to paper on the sale to the grantor trust. As always, if you have questions or topic suggestions, you can email me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.